Question number 151 on the screen, Excel file. Huh. The question says Murray had the following budget and actual results during a period. The budget, the original budget which they planned, is given at 1000 units, and the other details like sales and other costs are given. But the actual activity took place at 1380 using a flexed budget approach. That is, revising the budget according to the actual activity is flexible budgeting. So we have learned about that. What is the total adverse profit variance for the period is? What we need to do is we have to revise the original budget according to the actual activity. The actual activity is at 1380 units, but they planned it at 1000 units. So 1000 units have to be adjusted to 1380, then change all the other data, and then we take it forward. So just that is all what we have to do. Let's present it. Question number 151. One second. Okay. Now these are the details which are given. First, let's mention the number of units. So the number of units, initially they planned it for 1000. The actual happened at 1380. The point here is sales is given at, first let's focus only on the budget part of it. So it is given at 100,000. After that, the other items are, we have direct material, then direct labor, All direct costs are variable in nature. We know that part. So we just have to make the changes proportionately. And the overhead also, it's very clearly mentioned it is variable. There is one item which is fixed. So fixed overhead, how do we treat that? We will look into that. Now, let's fill this column 1000 units, which is the original budget. Direct material is 40,000. This is 20,000. Then this is 15,000. And this one is 10,000. Now, here we see that sales at 1000 units, if it is 100,000 or 100,000 or 1 lakh, the revised budget has to be adjusted according to the actual activity level, which is 1380. So at 1380, how much is it? So it's proportionate. So if it is for 1000, 1 lakh, 1380, how much? So 1 lakh into 1380 by 1000. So that is what we have to do, is equal to this. Next, we have direct material, direct labor, variable overhead. All three of them are variable costs. So variable costs vary proportionately. That point we understand. Variable cost varies proportionately. So the same logic applies. So the same logic, calculate that and then see what the figures are. Then we have fixed overhead. So fixed overhead at 1000 or at 1380, the amount would be the same. Actual anyway is given. Let's just fill the columns. So now the comparison will be between the revised budget and the actual. So otherwise it would be, the comparison would not be very useful or meaningful if we are comparing the uh, if we are comparing 1000 units level and 1380 units level. So now both of them are on par, 1380, 1380. So now we can take it up for comparison and note down what the variances are. So make a mention about what are the variances. In case of revenue, the actual revenue should be more than the budgeted revenue. Then only it is considered as favorable. Otherwise, it is adverse. So that point. Cost should be less than the budgeted. Revenue should be more than the budgeted. So that's the point what we have to remember. But revenue, we see that the actual revenue is less than the budgeted revenue. So find out what the difference is, which is 4140, and it is adverse. Next, this is also adverse because actual cost is more than the budgeted cost. Next, we have favorable 600. This is also favorable because actual cost is less than the budgeted cost. This is 1000 adverse. Now the overall variance, we will put it as total cost one column so that it will be easy. This is adverse. This is more than the 900 adverse. What about the profit? Profit is less than the budget. A similar one is 154. So let's take it up 154. The following budgeted information comes from the accounting records of Smith. We have the original budget given for 1000 units. In a period where the actual sales were 1200, what would be the flexible budget? That's it, flexed budget or the revised budget. Fine. Question number 154. The next question here is question number 158. A law firm has forecast its cash balances for the next 6 months as follows. We have the details for from month 1 till 6. Um, the net cash flow. What is net cash flow? Net is after deduction. What would be deducted? It would be the total receipts minus the total payments. Then we call that as net cash flow. So here the positive figures which are seen are surplus. The negative figures what are seen are deficit. So 2 months we see there is deficit. The rest of the months we see there are surplus figures. Then opening balance of cash. I hope you remember the cash budget format while explaining cash budget, but we didn't do anything in this particular format. It was only that specific adjustment, whatever was asked, we have taken it up. So the net cash flow, opening balance of cash is added up to find out what is the closing balance of cash. Staff are paid in the month that they perform work. The firm have taken on a new client where work will be performed in month 3, and the customer is expected to pay their 300,000 invoice in month 4. This work is invoiced at 50% markup on labor cost, the only directly attributable cost for the client work. The firm have an overdraft limit of 250,000 and want to test whether the limit will be breached if the customer fails to pay for the work performed. If the customer does not pay their invoice, by how much will the overdraft be exceeded in month 4? So this is the content. We see the closing cash balance of all 6 months. Only in 1 month, that is month 4, there is a negative balance. Negative balance to the extent of 110. They are anticipating here. The firm have taken on a new client where work will be performed in month 3, but the collection from the customer will be received in month 4, which is 300,000 invoice in month 4. This work is invoiced at 50% markup on labor cost, the only directly attributable cost for the labor. The firm have an overdraft limit of 250,000. So they can extend till that. Uh, when the business have accounts with the bank, so they can always utilize the overdraft facility which is given. Already they are in deficit to the extent of 110. So now they have um, done some work for the one customer in month 3, as against which the receipt will be collected in month 4. So month 4, if they receive the amount, that should help them to face this negative figure. 110 is the negative figure. So that can be sorted out. But right now, the consideration is, what if the customer does not pay? If the customer does not pay their invoice, by how much will the overdraft be exceeded in month 4? The question is only about month 4. So we see that closing cash balance in month 4. So that's minus 110. So now in between they have considered about taking up a new work where work will be performed in month 3 and the customer is expected to pay 300,000 invoice in month 4. This work is invoiced at 50% markup on labor cost. If they have to take up the work is performed. So work performed will result in more amount of spending. First they have to perform the work. Work doesn't come free of cost. They have to spend amount. After that, they are adding a markup of 50% and which will be collected in month 4. The work is performed in month 3. The amounts will be collected. This work is invoiced at 50% markup on labor cost, the only directly attributable cost for the client work. So 300 if they receive, then that see the amount which if they receive it from the customer, no issue would be there. But what if the customer does not pay? If the customer does not pay, they have to meet their payment for the work done and they have spent already 300,000. So that 300,000 will have an impact on their balance. Already they are running in negative balance. So for that, the additional payment which they have to make would be 300. 110 plus 300 will be 410. 410 is the requirement, but they also have an overdraft facility of 250,000. Second. So they have a negative cash balance of 410. But bank will allow them to overdraw only to the extent of 250. It says the question says that by how much will the overdraft be exceeded in month 4? Overdraft facility is only till 250. So over and above the overdraft, what is the um, excess amount if the customer fails to make the payment? So option C, 160. Question number 159. A retailer has forecast receipts for its first 3 months of operations as follows. For January, February, and March, we have the details. Customers who pay in the month of sales will receive a 5% settlement discount as part of the retailer's sensitivity analysis. It wants to examine the impact on receipts if only 15% of customers pay in the month of sales. With 55% of customers paying in the month following the sales. Find out what is the revised cash receipts in March would be. Do you have a 1 hour class today or 2 hours class? It is in my schedule mentioned as 1 hour. Is it 1 hour or 2 hours? Is it 1 hour?
Not informed.
What is it?
We don't say they didn't tell us that there was any changes.
Okay. So maybe it is an error that they have written in that. So you have requested for a postponement of class. When is that? That is day after tomorrow.
On the 8th, ma'am.
So today is 6th, no? Day 8th, day after. The sales units are given for 3 months. The payment part of it is split into paid in the same month 20%, then 50% in the following month, 30% in the third month. This is the cash budget which is already prepared. Now they want to test it. They are taking up a sensitivity analysis, that is changing the input variables to understand what is the impact it has on the output. So they want to test that if the customers pay in the same month, they are entitled to receive a 5% settlement discount. That we also see here also. Only 95% of the total amount will be paid. 20% of the total sales value into the percentage which is collected 95%. That is how it is calculated. But they want to make the changes here. That is to test that instead of 20% of them availing, only 15% would be availing this 5 discount, this 5% discount. Then the second month, that's the next month, the following month, in place of 50%, it would be 55%. We have to make the changes and observe what impact does it have. So that is what we have to prepare a revised cash budget. 62,200. So answer is 62,200 will be collected in the month of March.
Ma'am? Ma'am?
Yeah.
Ma'am, actually, I didn't understand the calculation of paid in the month, ma'am. That 15% into 0.95. I'm not getting 8,550, ma'am.
Okay. So the point is you can see the calculation in the formula bar. You can see, but first let's understand the question. The question says that, see the details given in the table. We see that the percentage of customers who would be paying in the same month is 20%. If they pay in the same month, they can avail a discount of 5%. That is also mentioned. Customers who pay in the month of sale will receive a 5% settlement discount. So instead of 100%, they would be paying only 95%. That's the point. But now they want to test what if only 15% of the customers avail the discount. So 15% of that, earlier in this table, the cash budget which they have prepared, 20% of them have availed this cash discount because they paid in the same month. Now, henceforth, only 15%. What if only 15% pay in the same month? So they take 15%. That is, we have 60,000 into 50%, 15% into they pay only 95% of the total amount. So that is how we calculate. So 60,000 into 15% into 95% of the total amount.
So the sales is in price amount, ma'am, not in the units.
It is not in units. It's given, no, sales is given as the total number of units into each unit at the rate of $40. So the calculation is already mentioned. These are not units. These are dollar value. So this is dollar 60,000, dollar 70,000, dollar 40,000.
Okay, ma'am.
Because the calculation is mentioned here, the total number of units into each unit at the rate of 40, then these are the values which have come up.
Yes, ma'am, I understood.
Yeah. I think you got confused with the number of units there.
Yes, ma'am.
See, we have question number 161. A manufacturer has prepared a production budget for the next 3 months based on the new assumption that closing inventory would be 20% of the next month's sales as follows: June, July, August. Sales, add closing inventory, less opening inventory, and production. The manufacturer wants to perform some sensitivity analysis on the basis that the inventory level is reduced to 10% of the following month's sales. The new budgeted production in July would be dash units. Inventory level. Okay. See, as of now, their closing inventory would be 20% of the next month's sales. But now the changes are to be made. So let's present it there in the Excel sheet. Question number 161. See, a manufacturer has prepared a production budget for the next 3 months based on new assumptions that closing inventory would be 20% of the next month's sales as follows. The manufacturer wants to perform sensitivity analysis on the basis that inventory level is reduced to 10%. So the next month's sales, the closing inventory would be like this. The closing inventory will be 20% of the next month. So 20% of 9,000 is 1,000. Two nines are 18, 1,800. So once there is closing inventory, we have it as opening inventory here. So it goes like this. So this is how the columns will be filled. Fine. But now, earlier they followed that 20% rule. Now they want to change it to 10%. So whatever we are able to fill it now, first let's fill it. Then we can discuss about what are the other things. Closing inventory henceforth will be only 10% of the next month's sales. So it's equal to into 10%. So we don't have information for others. Of course, we can find out about the opening inventory for June. June will be the before month. May's closing inventory will become June's opening inventory. So May's closing inventory will be 10% of June, and that 10% of June will be the opening inventory of June. So we can write it here. This will be 14,000 into 10%. But the closing inventory for August cannot be calculated because we do not have any detail about September. So let's pick only till June and July. So June production will be, anyway they have asked only for July. So we see sales plus the closing inventory minus the opening inventory. The same thing for July, but August we cannot find out. So let's not highlight that and stop it here only.
Ma'am,
Yeah.
we are assuming the closing inventory previous month, ma'am. That 14,000.
1400. This one.
No, ma'am, that sales in June.
Sales in June. What is the question? Sales in June is
Uh,
14,000.
Ma'am, no, ma'am. We are assuming that the sales in June as the closing inventory of May, ma'am.
No, no, no. 10% of the next month. No. If at all, let's say if we would have May here, we do not know other things, but at least we can know about the closing inventory. Closing inventory would be next month, which is 14,000 into 10%. That much at least we can find out. Of course, other details are not there. We do not have sales. We do not have opening stock. So closing stock of May will become opening stock of June. That is all what we can find out. It goes like this, no? So the previous month, I was showing the pattern. So it goes like this and then comes back. So it goes here and then it comes back.
Okay, ma'am.
That's the pattern. So
Now I understand, ma'am.
of course, it is not asked for June. It is only asked for July. But because the information is available, I just filled it. But August details, August closing inventory cannot be calculated. So we just left it like that.
Okay, ma'am.
I think that would be the end of numerical questions. In budgetary control. Of course, many theory questions are there. We have not touched them. All what we have now, the remaining topics are, we have short-term commercial decision making under the relevant cost is one topic. Break-even analysis is another one. Then a part of linear programming is there. I don't know how much you would understand. The last topic then we would have as risk and uncertainty in short term. So if this is taken up, the numericals would be done. After that, the rest of the time, we'll start with, again with the question number 1 from the examination kit. But this also will take some time. We'll start from question number 1. This time will be only the focus on theoretical questions. So that will be in a way of revising whatever we have done. So while discussing the theory questions, we will be doing a revision for this content for the remaining number of days. Just a second. The PPT. One second. So the next topic what we have is decision making. Under decision making, there are three topics. One is relevant cost, one is break-even analysis, one is linear programming. Okay, this is last but one chapter. After that, we have risk and uncertainty. So, what are relevant costs? Um, First, we have to understand about what are relevant. Relevance is in terms of what? Relevance is in terms of decision making. So, that we have to remember. Relevant cost, whenever we talk about relevant for decision making, it has there would be some influence of these costs on the decision making. That is what is the focus point there. So relevant costs. Then we have the concept of break-even analysis. So break-even analysis, I will give you a list of formulae. You can make a note of it. In certain situations where the resources are not abundantly available, in that case, we see that the decision have to be taken with those limiting factors, with those constraints, with the scarce resources. So in that case, we use the linear programming technique. In cost accounting, um, we take it up with the limiting factor analysis or key factor analysis. But if there are more than one constraint or one scarce resource, in that case, we use the linear programming. Little this is mathematical, but the coverage of syllabus for commerce students is not very complicated, but technically it is not a very simple topic if we were to learn it from mathematical aspect, the statistical coverage of or mathematical coverage of linear programming. um, there is a graphical method, there is a mathematical solution for this one, which we call it as simplex method. But they have ensured that the questions which are covered here in the Kaplan material, it is not very complicated. So we can also, even if we have no mathematical background, I've never learned about linear programming also, we still can pick it up. So that point is there. So first, let's talk about what is relevant cost. Now, in case of decision making, what is relevant, what is not relevant is what has to be first understood. The list of relevant costs are mentioned. What is relevant? See here, relevant costs and revenue. We see that what is relevant, what is non-relevant. Relevant costs are all the variable costs are relevant because they change with the decision. So whatever decision is taken, they change proportionately. So material cost, labor cost, all that will be relevant for decision making. There is something called as opportunity cost here. Okay, opportunity cost is the cost of um, foregoing the next best alternative is opportunity cost. So in case of decision making, what is the benefit which would not be availed because of choosing one alternative also has to be considered. So that is also relevant for decision making. So if we are taking a decision about investing in X business or investing in Y business, so what is X business offering, what is Y business offering? Ultimately, only one decision can be taken up with the available amount of investment. So if that is the case, if only one decision is chosen, the benefits which are associated with the other alternative are not available, they are foregone. So now that is a decision which is taken for the future period of time. So we are and we would analyze about what are the benefits if availed, if one alternative is chosen, what can be availed, what cannot be availed, whatever is not received, whatever is foregone is opportunity cost. So that also has to be taken into consideration. Then all cash transactions are relevant because the amount of cash has to be paid in the current period. Then any future cash flows are also relevant for, because we would be considering whether to go with the investment in the present, whether to go ahead or not is considered. So that will be the future cash flows. Those cash flows are also relevant for decision making. One second. sorry, word this one. Okay. Um, so what are the relevant for decision making? So all variable costs are relevant for decision making. Opportunity costs are relevant for decision making. The cash transactions will be relevant for decision making. The future cash flows also will be relevant for decision making. Any incremental cost. So if we are adopting from the past data, if that past data has to be adjusted according to the incremental changes, so incremental cost cash flows also are relevant for decision making. Then we see there is one thing called as avoidable costs. What are avoidable costs? Avoidable costs are also relevant for decision making. Earlier also, I'm assuming I have mentioned it to you, but if I have not, let's see. Fixed cost, by nature, it is constant. It doesn't change. But if there are decisions taken to reduce the activity, a portion of the fixed cost can be avoided. We call it as avoidable fixed cost, or another term is that is called as traceable fixed cost, traceable or avoidable fixed cost. So if a decision is taken to reduce the activity, if the cost can be avoided, we call that as avoidable fixed cost. That is also relevant for decision making. So if they reduce the activity, how much is the reduction in the cost? That is the decision. Now the decision gets affected by the amount of fixed cost which can be avoided. All these costs are relevant for decision making. But there are certain costs which are not relevant for decision making. What are they? All costs which are already incurred, historic in nature, we also call them as sunk costs. They already happened. Nothing can be done to undo those costs. So they are irrelevant completely. So if fixed costs are categorized as traceable, avoidable, then we have another set of costs which are unavoidable. If they are unavoidable, they would be unavoidable because there was a commitment made regarding these things in the past and they are continued to be incurred. So we call them as committed fixed cost. Committed fixed cost, like um, let's say, for example, they have entered into a lease agreement. They have entered into a lease agreement. As long as the lease period is there, their commitment is there to incur that fixed cost. So those are committed fixed costs. Then depreciation is one expense. Um, uh, Throughout the life of the asset, depreciation amount has to be charged to the income statement. So that is a committed. That is also a committed cost, but it is shown separately a category as depreciation. They have to be charged. Any decision taken by the manager will not alter these amounts. Okay, they are to be shown in the income statement. There is another item called as notional cost. Notional, or we also call that as imputed cost. Notional cost or imputed cost is not notional, is not real something. Notion, it is an idea, it is not real. Like they are not incurred, but they are accounted because of the principles of accounting. Examples like interest paid on the capital. Now the business is owner's business. Why would the owner collect interest? Who would pay interest to them? Salary paid to the owner. So there are certain items. This owner is managing the business. Why would he collect salary? But that is allowed according to the principles of accounting, because owner and business are two different entities. Therefore, owner is entitled to receive salary. Interest is received. owner is entitled to receive salary. Business is supposed to pay interest or be supposed to pay salary to the owner, but they do in reality they do not actually happen, but they are allowed to be shown. So they would be accounted there. There is no cash outflow technically which goes out of that, but they are present in the income statement, which cannot be altered. They would be anyway there. So they any decision taken, these costs will be there in the books of accounts. So they are absolutely irrelevant for decision making. So that is the point what we have to remember. So as we take up the questions based on what are the relevant costs and irrelevant costs, we will clearly understand. So the relevance part of it is about whether a decision can be taken to alter the amount. If the decision taken has an impact on the amount, that becomes a relevant cost. If a decision is taken and yet there is no impact on the cost, that will be a non-relevant, irrelevant cost, irrelevant for decision making. Then we have what are the other decisions? There are common types of decisions about see, make or buy, limiting factor, accept or reject, minimum price, shutdown decisions, further processing. These are all relevant decisions. The numericals are there. I do not know what numericals are there, but whatever numericals are there, we will take it up and then we will look into that. Then, apart from this, apart from the financial aspects, there are certain other non-financial qualitative factors that also we can look into that. Now, there are few examples given about material, about labor. There are two examples given. I mean, how the decisions are taken. Let's have a look at that. Let's suppose if a decision has to be taken with respect to material. Are the materials already in stock? So the decision about the material, whether material has to be purchased or not. So this is flow charting. So connecting with the arrow marks and then taking a decision about it. For example, if the material, checking out whether material is available in stock. If it is yes, if it is no. If it is no, if the material is not there in stock, then they have to purchase. What is the cost of purchase? If it is already there in stock, would they be considering it for replacing the material? If it is replacing, what is the replacement cost? If they do not require any replacement, will it be used for any other purpose? If there is any other purpose, what is the opportunity cost of it? If this will not be used for any other purpose, if there is if it would be used for any other purpose, what's the opportunity cost of alternative use? Otherwise, what is the net realizable value? Similarly, for labor and overhead, if it is labor and variable overhead, is there any spare capacity or no spare capacity? Can additional labor be hired? It goes like that, right? Decisions would be taken in this particular fashion. Now, what are the major areas where decisions are to be taken? So, the common types of decisions. So that is what is the topic what we are going to study. What are the major decisions? The decision making, the short-term decisions. The first one we see that special order pricing, then accept reject decisions, further processing, shutdown, make or buy or outsourcing, then limiting factor. These are the decisions um, which have to be arrived at. We have to take decisions related to that. So the first one, special order. See, special order pricing is what should be the price for special order. The concept is what should be the price for special order. The special order is not a regular customer. That's the first point. It is not a regular. This order is not from a regular customer, but there is a potential to convert this special order into a regular customer, regular order. So to attract the customer, so first the customer has to get attracted. So then what is done? A first time offer or some offer is given, and then the strategy which is adopted in case of special orders is the price is reduced for the customer. But how does it work out? You also must have come across referral code is given, and when they avail that first time purchase offer or code, then you can avail it at a discount price. How does it work out when the same product is sold to all the customers, all the regular customers at the regular prices? Why would the special order be offered to certain orders at a discounted price? This is always, I mean, this is most of the time at a discounted price, not at the regular price. That's why we call it a special order price. The logic behind this goes like this. See, first let's understand the broad category of cost. We see that there is variable cost and we see there is fixed cost. Variable cost is a cost which varies proportionately with the output. Fixed cost is a cost which does not vary proportionately with the output. It remains fixed. It remains fixed till it reaches the maximum capacity. Okay. Only when it reaches the maximum capacity, exceeds the maximum capacity, fixed cost also changes. But otherwise, fixed cost does not change. Let's see that on a scale of capacity starting from 0 till 100% capacity, if we are talking about this one, at 0 capacity, at 100% capacity. Just because capacity is available, businesses don't go in for operating at 100% capacity, produce all the goods and sell them. The decision about at what capacity they would be operating depends on what is the demand for the product. So only as much as the market is ready to absorb the demand, they take up the production at that capacity. Let's say, for example, let's say that they are operating at 70% capacity. So there is unused capacity. We see there is unused capacity of 30%. So this unused capacity, when they utilize that and offer this discount to the special orders. But again, how is that discount possible to be given? So now they are operating at 70% capacity, producing the products and selling them. So the products would be sold at a selling price. How is selling price decided? Selling price is decided as, what's the equation for selling price? We have it as cost price. Am I audible? Cost price plus profit. What is cost price? Cost price is the total cost. What is total cost? Both variable cost plus fixed cost. So fixed cost at 0 number of units, whatever is incurred, it would be same till 100%. So now they are operating at 70% capacity. At 70% capacity, they would include the total amount of fixed cost in the total cost. So total cost will be the total variable cost till 70% capacity plus the total fixed cost will give us the total cost. So total cost, find out what is the cost price per unit, add a profit margin, and selling price per unit is decided. So right now, when they are operating at 70% capacity, producing the products and selling them, the selling price decided at this level will take care of all the variable cost and all the fixed cost which is incurred till that point. The point about fixed cost is, see, it will not change until it reaches the 100% capacity. It will not change. It will remain the same thing. So, which means to say that if they take up the additional unused capacity, they will not incur any more fixed cost. That additional 30% capacity which they want to utilize now, when they are utilizing that capacity, they will not be incurring any amount of fixed cost, but only the variable cost is incurred. Because it is only the variable cost which is incurred, their focus will be on recovering the variable cost. Now, no more fixed cost. Fixed cost is taken care by the selling price at 70% capacity. So, the special orders which are taken up over and above the existing capacity level by utilizing the unused capacity level, there the selling price will be decided as variable cost plus profit margin. So that is how it becomes possible for them to offer it at a discounted price. So even when you see that first time purchases, there is a discount given. How does it work out for them? Why would they give any discount? This is a strategy to attract the customer. So the customer feels so elated that yes, they have availed a discount of so much, or the seller has given them a discount, and then if they are convinced, they become their regular customers. So that's the strategy which is followed. That is about the special order pricing. Let's look into the examination kit. The relevant cost and decision making. The first question is about special order. Question, sorry. Question number 162. An organization is considering the cost to be incurred in respect of a special order opportunity. The order would require 1,250 kgs of material D. This is a material that is readily available and regularly used by the organization on its normal products. There are 265 kgs of material D in stock, which cost $795 last week. The current market price is 3.24 per kg. Material D is normally used to make product X. Each unit of X requires 3 kgs of material D, and if material D is costed at $3 per kg, each unit of X yields a contribution of $15. What is the relevant cost of material D to be included in the costing of the special order? Let me start a new Excel sheet. Just now we have looked into the PPT about what are the relevant costs. A list of costs are relevant for decision making. We see all variable costs, material costs, labor costs, opportunity costs, cash flows, cash expenses, future expenses, future cash flows, incremental cash flows, avoidable costs. These are all relevant. Now, getting back to the question. So first we need to find out what is relevant in this particular case. The decision is about they require 1250 kgs of material D. This is a material that is readily available. There are 265 kgs of material D in stock, which cost 795 last week. Current market price is 3.24. Material D is normally used to make product X. Product X requires 3 kgs of material D. And if material D is costed at 3 per kg, each unit of X yields a contribution of 50. Everything is related to material only. Do we see material cost as relevant? Material cost is a relevant cost because that's a variable cost and it is relevant. What is irrelevant? Already whatever happened in the past, the old, the historical cost, the sunk cost, they are all irrelevant. At present, what is the cash flow? Material is a relevant item. The cost of material is a relevant cost. That is agreed. So we see that now they are considering a special order opportunity. So in case of special order opportunity, what is the relevant cost of material D? So how much is the material D? The details about material D are the order would require 1250 kgs of material D. That is one piece of information. They have 265 kgs of material D in stock, which cost 795 last week, historical in nature. If it is historical in nature, it is not relevant for decision making. They have already purchased that, that is already incurred. They are there in the stores department, 265 kgs. Nothing can be done to undo that. So that piece of information is irrelevant for us for decision making. The current market price is 3.24 per kg. Okay, that is this piece of information, is it relevant or not, is what we have to look into. Because the special order has to be catered to in the present period. So the cost of material, the current cost of material is 3.24, relevant for decision making. Material D is normally used to make product X. Each unit of material X requires 3 kgs of material D. And if material D is costed at 3 per kg, each unit of X yields a contribution of 50. So some additional information about what is the requirement of material, etc. So that part of it is given in this particular paragraph. And if material D is costed at $3 per kg, each unit of X yields a contribution of $15. What is the relevant cost of material D to be included in the costing of special order? Nothing out of this particular last paragraph is relevant. What is the consumption usage? How many kgs are taken? Now they should consider about what costs become relevant for decision making for special order. So how much is the quantity which is to be considered? The order requires 1250. So the price of the past is not relevant. The current market price is relevant because that is at that cost they have to purchase the material. So current market price. 3.2. So the answer is 4050. The relevant cost of material D is 4050.
Ma'am,
Yes.
ma'am, for the relevant cost, we usually calculate on the new material, ma'am. We won't be considering the existing 265 kgs or adjusting with the requirement of the special order. We won't do that, ma'am, in the relevant cost.
You mean to say the consuming of the material?
No, ma'am. Actually the question says that the special order requires 1,250 kgs, but they already having like 265 kgs of material D in stock. But do we consider and adjust the 265 in that 1,250, or relevant cost will be calculated on the new one, ma'am, not on the
the, um, one second. Let me put you through the PPT. If a decision has to be taken, the decision about purchasing the material at the current rate versus the historical they already purchased. Now what decision will they take? So the decision, the relevance of the cost will be related to only 1,250 if they are purchased at whatever is the rate. Okay, but the other units which are there, one second. The units which are there, that is there are 265 kgs of material D in stock. Now nothing has to be done to take it up. We are not deciding on the selling price. We are only deciding about what is relevant for decision making. We are not talking about what is the consumption, which material will be taken, what is the cost of inventory. That to that level we did not come. The question is only simple about if the decision about the material has to be taken. Now to be considered decision is only related to 1250 purchased at 3.24. Already purchased 265 kgs at a cost of 795. It is already happened. It is a historical cost. Now that is not considered for decision making. The question which you have asked is also the correct one, but the question is not asking us to find out what is the cost of the inventory used for the special order. We didn't come to that level. It is a very basic question. Between the two sets of information, which one is relevant for decision making? So 1250 at 3.24 is relevant. Whether they will be purchasing that is not a criteria, because how much will they purchase? Will they utilize 265? That in situations where we have to take decisions about what is the consumption of material to prepare for the special order. So that is, we have not yet come to that point.
Okay, ma'am.
So we have another question in the question mark 163. H Limited has in stock 15,000 kgs of M, a raw material which it bought for $3 per kg 5 years ago for a product line which was discontinued 4 years ago. At present, M has no use in its existing state but could be sold as scrap for $1 per kg. One of the company's current products, HN, requires 4 kg of raw material which is available for $5 per kg. M can be modified at a cost of 0.75 per kg so that it may be used as a substitute for this material. However, after modification, 5 kgs of M is required for every unit of HN to be produced. H Limited has now received an invitation to tender for a product which could use M in its present state. What is the relevant cost per kg of M to be included in the cost estimate for the tender? H Limited has in stock 15,000 kgs of material, bought it for $3 per kg 5 years ago. So this is historical in nature. And for a product line which was discontinued 4 years ago. So at present, M has no use in its existing state, but could be sold at a scrap of 1 per kg. One of the company's current products requires 4 kgs of raw material, which is available for $5 per kg. M can be modified at a cost of 0.75 per kg so that it may be used as a substitute for this material. However, after modification, 5 kgs of M is required for every unit of HN to be produced. What is the relevant cost per kg of M to be included in the cost estimate for the tender? So relevant cost is about something was discontinued 4 years ago. So if something was discontinued 4 years ago, there was some material M which is available. Either it could be sold as a scrap. Then one of the company's current products requires 4 kgs of raw material, which is available for $5 per kg. So the current market price of this material is at 5 kg, $5 per kg. To make it usable, they will have to spend 0.75 per kg to modify the material. Okay, to modify the material. After modifying the material, it would require 5 kgs of M is required for every unit of HN to be produced. The relevant cost will be 4 kgs of material acquired at the current market price, which is 5. That subject to the adjustment of the modification cost of 0.75 per kg, but that will be consuming at the rate of 5 kgs for every single unit. So 0.75 into 5. Let's check it out. How do we calculate the relevant cost? modification costs are 0.75 per kg of material, but this will be requiring 5 kgs of material. 0.75 per kg into 5 kgs of material. So that is the modification cost. Relevant cost is 16.25. 16.25 per 5 kgs of materials. One unit requires how much? See, if they purchase it from external market, 1 unit of this product which is produced requires 4 kgs of material. But if already the material which is available or of the discontinued process, the material which is available from there, that if it is modified will require 5 kgs of material. So the cost of modification is 3.75. If they purchase it from the um, external market, the current market price of that is 20. So if they use the internal thing, the cost will be 3.75. So the relevance will be 20 as against 3.75. So the decision making, how much would they be spending? See, 3.75 is already present there in that the material is already present there. All what they would be requiring is only the modification cost. So modification cost is all what they have to make the material available. So the decision is as against 20 versus 3.75, 16.25 is the relevance. Now that 16.25 is the cost of all 5 kgs of the present material which is used. However, after modification, 5 kgs of material M is required for every unit of HN to be produced. So the question is asking us what is the relevant cost per kg of M to be included in the cost estimate for the tender. So, okay, 3.25 per kg. Okay, I'll take up the other questions tomorrow. Is that fine? We have some more questions here in the exam kit. These are all about relevant costs only. So the other questions I'll take it up tomorrow, and we'll take up the other cases also. Quite many questions are there, numerical questions are there in this particular topic. Take some time for us to do this. Okay, I'll